Global markets wobble after Trump says he'll impose 25% tariffs on imports from Mexico and Canada on his first day in office. The Aussie and Kiwi dollars slide to near one-year lows. The Reserve Bank of New Zealand is expected to cut by 50 basis points later today. And in Australia, the RBA will be watching for disinflation progress. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview ahead of today's Reserve Bank of New Zealand decision, ANZ senior economist Miles Workman analyses last week's growth warning from the New Zealand Treasury.
There's no reason here to conclude that they won't continue to forecast a decent recovery over the latter part of their forecast horizon as lower interest rates do provide support.
But first, in 5 and 5 with ANZ, global stocks, bonds and currencies were volatile overnight after President-elect Donald Trump threatened to impose 25% tariffs on all imports from Canada and Mexico on his first day in office, arguing America's neighbours weren't doing enough to stop illegal immigrants and drugs crossing the border. The Dow fell 0.3% by 4 a.m. Sydney-Melbourne time, while the S&P 500 was up 0.3%, and US Treasury yields rose between 3 and 6 basis points. That pushed up the US dollar index around 0.2%, and the Aussie and Kiwi dollars fell to near one-year lows. The Aussie was down 0.7% at 64.58 US cents, and the Kiwi was down 0.4% at 58.23 US cents. Traders tonight turn their attention to the US Federal Reserve's preferred PCE inflation data for October, that's personal consumption expenditure, which comes off the back of firm consumer and producer price readings. ANZ head of G3 Economics Brian Martin says the market expectation is for PCE inflation to have risen 0.3% in October.
That would leave core inflation running at 2.8% year on year. I think that certainly means that the debate as to whether or not the Fed would pause in December will very much be live. But for me, one of the swing factors is going to be the labour market report. So I don't think a conclusive decision can be made about the FOMC's next policy step until we see how the labour market report in November has performed.
Number 2, the Reserve Bank of New Zealand makes its final rates decision of the year today. ANZ New Zealand Chief Economist Sharon Zollner and the market are expecting another 50 basis point cut to 4.25%. Sharon says that beyond that, nuance about the future is key.
That's both the Reserve Bank's forecast for the official cash rate, whether it still stops at the same place, for example, around 3%, but also any commentary about risks to the upside and the downside about what decisions they considered. We think the Reserve Bank will be quite satisfied with the progress that they've made on disinflation. Although headline inflation is right near the target, the mix of inflation still has a way to go, with domestic inflation still nearly 5%. The economy has been very soft. So in that context, I don't think they'll be unhappy to see signs of life in the economy. Certainly, business confidence survey, as well as the housing market, has taken note of the fact that rates have come down quite a bit. So that doesn't speak to a need for emergency cuts.
Number 3. Also today is Australia's October CPI indicator. ANZ Research expects a decline of 0.2 percentage points from September and for the annual headline measure to rise by the same amount to 2.3%. Here's ANZ Group Chief Economist Richard Yetzinger.
What will matter is, can you get a sense from these numbers that the decline in inflation is continuing or not? And look, that could be headline, it could be one of the more underlying measures, and they're all subject to various issues, particularly given this is a number for the first month of the quarter, where it's not the full sample size. So we'll have to just wait and see. I think that fundamental question is there evidence of further ongoing disinflation or not? And we need that disinflation just to provide the ground for the bank to ease. Even disinflation doesn't guarantee a February rate cut by any means.
Number 4. ANZ Roy Morgan consumer confidence in Australia dropped just over a point last week to 87.5, while inflation expectations hit a 3-month high of 5%. ANZ economist Sophia Angala says all of the main sub-indices fell, except for the time to buy a major household item index.
It rose 2.5 points to 81.5 points last week, and the sub-index is now up over 11 points since early July. And this is the strongest gain amongst the sub-indices over the same period, and the series is now at its strongest since around late 2022. But last week's rise is likely linked to Black Friday sales events, which are enticing price-conscious households to partake.
Number 5. Some welcome news for the inflation-seeking Bank of Japan, as services producer prices rose 2.9% annually in October, from an upwardly revised 2.8% in September. ANZ FX analyst Felix Ryan says the monthly rise of 0.8% was the strongest since April.
If we take that PPI services number and we combine it with some of the underlying strength in price pressures within the latest CPI report, national CPI last Friday, and also some of the PMI price gauges, it does seem that some of the domestically driven services inflation are building in Japan, and that's something that the Bank of Japan will be quite happy to see and does reinforce our view of a 25 basis point rate hike at the coming meeting in December.
Felix Ryan there. Now, for our deep dive interview, ahead of today's New Zealand rates review, ANZ senior economist Miles Workman says last week's growth warning from the Treasury shouldn't be too much cause for concern for those following recent economic data prints.
Based on that speech, it does look like the Treasury will downgrade their forecast for real GDP, at least in the near term, and that appears to be largely driven by the simple fact that some of the data has come in a bit softer than their expectation. But at the same time, there's no reason here to conclude that they won't continue to forecast a decent recovery over the later part of their forecast horizon as lower interest rates do provide support. So there is a little bit to unpack. I mean, there's a bit of an assumption tweak that is likely to make its way into the HIEFU economic forecasts, and that's where essentially the Treasury's previously heroic productivity assumptions look like they are in for a bit of a downgrade come HIEFU. So all else equal, that would imply a smaller real economy overall, but the overall tax take at the same time has actually been close to forecast.
And how does that fit into your projections for the New Zealand economy, and in particular the fiscal side of things?
I think broadly speaking this is pretty consistent with where we've seen things. So in terms of the Treasury's productivity assumption, we noted back in budget when we reviewed the budget forecasts that their productivity assumption just looked optimistic at the time. It turns out we were probably right about that, and the HIEFU will downgrade it. So what I'm really saying here is that there isn't a lot of surprise. I think the direction and travel for where the Treasury's economic forecasts are going, that's not a surprise to us. We thought they were probably a little bit on the rosy side at the budget, so a downgrade come HIEFU really doesn't surprise us overall. In terms of what that means for monetary policy, no major impacts here. What really matters there is actually the discretionary side of fiscal settings, and I think Minister Willis is certainly keen to stick to her guns there in terms of sticking to those signalled operating allowances in pursuit of a very overdue fiscal consolidation. So I wouldn't call any of this a game changer at all relative to our view.
So Treasury have said a few times recently that New Zealand's facing a structural deficit. Do you see any sort of thinking or action there to address that?
Structural deficits are forecast by the Treasury, that at least at budget they were all the way until 2028 before we saw the first structural balance surplus. And from a fiscal sustainability perspective, that's pretty worrying. I mean, not returning to surplus in an appropriate time frame sets an extremely dangerous precedent for subsequent governments, increasing the risk that you do get some kind of debt crisis in the future if governments don't maintain a healthy fiscal position over the longer run. So I think what this speech is really doing is it's just outlining that things are challenging economically, but there is a trade-off there of having to get the books back into shape as well. I mean, clearly the government's fiscal policy has certainly focused on consolidation via spending restraint, with no real desire to look at the revenue side to bolster the consolidation. And previously, fiscal strategies towards fiscal consolidation have often included revenue settings as well. So that would be increasing taxes or broadening the tax rates, maybe introducing new types of taxes, that kind of thing. But this government has certainly said or suggested that that's just not on the table for them. So based on the government's policy stance, it would just appear that this is a note that any downgrade that we do see to the fiscals is more likely to be driven by economic forces rather than discretionary fiscal policy forces.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 27th. Catch you tomorrow with all the reaction to today's rates decision in New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.